gap up and gap down markets. So we generally cover for intraday alone, we generally take around 10 strategies for stocks and for indexes. 10 plus strategies will be there only for intraday. And we also cover positional trading and swing trading as well in the entire course. But here, based upon the gap up and gap down markets, for gap up market, there are 3 strategies. For gap down market, there are 3 strategies that we generally cover. But here I'm just going to explain you the importance of gap up and gap down markets and how and why they occur, so that you will understand that there will be a trading opportunity, intraday trading opportunity in a gap up and gap down market situations. So here, what are the gaps? Basically, you can see that market, once it closes at one level and tomorrow morning it will open at a different level. If it is gapping up, if it's opening at a higher price than the previous yesterday's price, it's called a gap up. If it's at opening at a lower level, we will call it as a gap down. So what are the basic reasons for the gap up and gap down? Most of the reasons could be our markets are affected by global markets as well, which is the US markets and European markets. That is one of the way. And secondly, whatever happens after 3:30. So many things can happen, many news can come out after 3:30 as well. So those things also will affect the gap up and gap down situation, because the overall sentiment of the market, of the news that happens after 3:30 can also affect Indian market sentiment, global market sentiment. And finally, if any particular stock is there, here we are talking about the overall market, Nifty or Bank Nifty, like that. Any particular sector also can affect, because the news might come out that at 6 o'clock, something news might come out about metal prices, metal imports are metal that duty has been raised, or anything, whatever impacts that particular sector will impact that particular sector stocks on the next day. That is one thing. Or let's say any company has released the results, or they have announced something after the market hours, particular company, let's say Reliance or SBI or like Vedanta. So whatever it is there, that particular stock might have a gap up or gap down situation based on that particular news as well. That is, those are the few of the things why gap up and gap down occur. But practically how it will occur, how will the gap will form? What do you mean by that gap? So that means, let's say after 3:30, you got a news. Let's say like there's a very good news about any particular company. They have launching a new product or anything, and it's having a very good market. Now you want to buy that particular stock. Let's say you want to like, there is some Hindustan Unilever, let's take it. So you want to buy that particular stock, but after 3:30 you can't buy it in the market. What you can do, you can open up a post-market order. You can go to broker platform and then like keep an order for buying this much of quantity of Hindustan Unilever at this particular price, or you can also put it at a market price that will open, whatever the market price that opens, you will get at that particular level. But that level, that order will not get executed. That will be pending with the broker only, because the exchange is closed. That is post-market orders. Then during the market from 9 o'clock, 9 a.m. till 9:08 in the morning, you can place pre-market order. So there is also you can place over here. So your post-market orders can be there. There are pre-market orders. So there are so many orders like that for the entire market. For the Nifty also, there can be call options, put options in the post-market and pre-market. Millions of, because we can see that there is something called SGX Nifty that will tell us that whether the market is going to gap up or gap down. Based on the SGX Nifty also, there can be many pre-orders and post-market orders that are available. Then what happens is all these orders will be pending with the different brokers. Then at 9:08 to 9:13, during this point of time, all this order will get transferred to the exchanges like NSE and BSE. So at 9:08 to 9:13, these orders will get to the exchange, and mostly during 9:14 and 9:15, you can see that the gap up. See what happens. Let's say that so many millions of buy orders are there, net buy orders. So many people wants to buy call options of Nifty. Then what happens? The buying pressure will increase, and so much of transactions has happened just in 2 minutes. What that will do? The price will take from here to here, because so many transactions has happened. That has to be understood as a bull candle. Let's say if the price gapped up, that is nothing but, if it happens in the live market, there could have been a bull candle, right? So if it is happening in the after the market, and once the market opens, this gap will happen. That is the logical reason as to why practically the gap ups will happen. It will look like this. It's a 5 minutes time frame. So E here indicates earnings. So in trading view, you can easily see that whenever there is the earnings over here, it indicates E indicates earnings. So because it's related to some news, the price gapped up. After this, price went up. Now, what is the important thing for us to learn over here is when the market gaps up. See, let me show in the Nifty itself. Let me remove these zones and let me show you that, or let us keep the zones so that you will understand. Okay, now today is not a great gap up or gap down market. Yesterday also it's not a great, but here on this particular day there was a gap down market, and gap down market, it did not go down, it went up, and so it did not cover the complete gap. Finally, it went up and covered the gap. So this is the gap level, right? This gap level has been covered up. Gap covering happened on this particular day. For the gap down and gap covering has happened on this particular day. Just like that. Okay, see this. There's a gap up situation. Gap up, and today the gap covering did not happen. Gap up happened, pullback and continuation happened. So one day gap covering is happening, one day gap covering is not happening. On this day there is no gap up. On this day again there is a gap up and gap covering did not happen. This is the gap. It did not get filled and it went up. And today, see this. On this particular day, it looks like as if there is a good gap up and then continuous green candles, right? And there's institutional zones over here. And here this gap has been filled on this particular day. So how will you identify that whether when the gap up happens, will it continue on upside or will it come back and cover the gap, or even during gap down situations, will it continue on the downward side or will it come back and cover the gap? If it happens, what are the trade techniques that you need to follow? In this case, gap down and sideways. So like that, here, these are the beautiful scenarios where you can cover entire thing. So most of the move can be covered. There is a strategy with one of the moving average technique is there. Not for entry, but for trailing stop loss, that technique can be useful so that you can cover this kind of a entire thing in the, when it happens, you should not miss that. Because whatever happens at least once in 10 days, if this kind of a situation can happen, you can cover, if you can enter here complete day till here, you can hold that particular stock using that technique. That is not for entry technique, but for trailing your stop losses. Okay, now this is a beautiful way of a breakout. Bull candle, resistance, a proper breakout, and retest and continuation. So this is a very good entry at this point at the institutional zones level. So there are some of the techniques, but here I'm just explaining that gap up and gap downs also will help us as an intraday trader. So don't panic that if you're an intraday trader, whatever happens in the after the market hours, you will not be worried about anything, because if you're holding stocks, then if the market is gapping down, then you might be fearful because your holdings might lose value. But if you're an intraday trader, whatever happens in the market, let it be huge crash or let it be huge rally, you can purchase call options or you can buy put options in the intraday specifically, or else if you're trading stocks, you can buy the stocks or they sell the stocks for intraday.